So in this lecture, we're going to look at inventory management. We're going to look at inventory management, and under that, we are looking at material accounting. At the end of this lecture, students should understand, or I expected to understand the importance of material accounting, know the basis of material costing, know the method of pricing material issues, and understand the uses of pricing methods. Adequate material accounting accounts are necessary for a variety of reasons, of which the following the most important. One, to indicate the value of stores in stock and to provide the basis for material costing, and to also provide the means of operating stock control by value. So these are the three areas we are going to look at. We want to know the value of stock in our stores, because when we keep too much inventory, that will mean that we'll be tying up working capital in stock. And also, because we use some of these stock in, as it were, in doing some jobs within the organization, it's important to know which costing methods to apply so that we can just leverage on that and then do the proper thing. And also, we want to understand the means of operating stock control by value. We need to establish the opening stock, the closing stock at each point in time when we are dealing with inventory. The value of store in stock. It is important to know at all time how much working capital is represented by stores in stock. And we have discussed that. I've indicated that that is the reason why it's important to be able to cost inventory, so we know the opening stock and the closing stock. And stock appears in the balance sheet as current asset and is sometimes called liquid asset. For balance sheet purposes, the normal value is that stock. That stock should be valued at cost or market price, whichever is lower, to avoid an overstatement of the stock. So what we are saying here is that stock should be valued not at the market price, but at cost. If the cost price is more than the market price, then you maintain the market price, whichever is lower. Basis of material costing. So stores accounting facilitates material accounting in two ways. First of all, they provide prices by means of which the cost of any material item can be calculated. And secondly, we're able to compare the total value of material charges to various jobs or activities. Provides a check that all materials have been properly costed. So what we are saying here is that we have the basis to be able to calculate a particular item because we are able to cost it. And then also we are able to know the total value of material that are charged to various jobs because we're able to do some sort of comparison if we have the value of stock. Some companies, what they do is that they are into also doing some jobs. They buy raw materials to execute some jobs. So for instance, a car repair shop where they buy engine oil, they buy boot and nuts, they buy filters. And what they do is that they use in servicing the car. How do we cost these materials, these raw materials that we use? How would we cost them? Spare parts, how do we cost them in costing or arriving at the cost so that we can charge whichever customer we are dealing with? Or even if it's a transport department, how do we cost this? And it's important that we are able to do that comparison. And that's why we should be able to do the material accounting. So one of the first things that we need to do or one of the areas that helps us in identify or ascertaining the true cost of the stock or inventory is the supplier's price. And we're saying that supplier's price are quoted by suppliers in various ways: net prices or the list prices, discount inclusive, or exclusive of freight, customs, and insurance of packages. And for costing purposes, we must arrive at a figure which will represent the cost actually incurred up to the point of delivery of the goods. So to do this, a purchase price is calculated by taking the supplier's price at base, deducting any trade or quantity discount, and adding any other expenses already incurred. So we are just looking at the price of the product up to the point of selling it to the customer. So we add all those additional cost. And if there are any discounts, we deduct the discount from it so that we don't overstate the cost. Now, what is trade discount? Trade discount is granted by manufacturers to distributors. Take note of that. Manufacturers to distributors. And it is usually expressed as a percentage of the list price and may or may not vary with the quantity bought. It may or may not vary, but make sure understand that it's between manufacturers and distributors, and it is deducted from the supplier's list price. Quantity discounts, it's given to customers for making bulk purchases as frequently allowed by special rebate, and it is based on what? It's a quantity. So for bulk purchases, we have transport charges, which as a rule is normally what? Deducted. So quantity discount is also deducted. Transport charges are also are added instead. They are not deducted. Quantity discount are deducted. Transport charges are added up. So to be able to get the true cost of the inventory. So as a general rule, supplier's price include the cost of transport, but where this is not so, charges, whether paid to the supplier or carrier, it should be added as I indicated. Insurance, any separate expenses incurred in insurance should be added back. Custom duties also should be added back. And it's just like our market women or those at our malls who sell groceries and they sell food items and all that. The cost of carrying these items from the supplier to that mall, they add all those costs, the carriage costs and the insurance and all that to it before they can add their margin to it, their profit margin to it. So that is the cost that we are talking about. Okay, so we have non-returnable packages, and we are saying that the supplier price normally includes the cost of packages, but when a separate charge is made, it should be added to the basic price. It should be added if there's a separate charge that is made. And returnable package, if returnable packages are not charged separately, or if they are charged or credited at the same value, they can be ignored. Where the amount credited on return is less, now take note of that. When it's less than original charge made, the difference is added to the supplier's price in arriving at the purpose price. So this is just some calculation work example that you can go through as an exercise where you have the quantity discount and other variables in there. You can look at it and then compare it with the answers, okay, to see whether you are on course. So I'll skip this, but let's look at cash discount. Cash discount is not part of this because it is paid for. It is paid normally for what? It is charged for what? Prompt payment, or it is allowed for prompt payment. That discount is given to whoever pays, and it's normally a percentage of the lump sum. So if you decide to pay early, buy something and pay promptly, they could give you a cash discount. And we see this thing every day. They tell you that, okay, You could buy this thing at maybe $10,000, but if you're paying it immediately, it is $9,500. But if you're paying in 2 weeks, maybe you're going to pay the $10,000. So for prompt payment, we use the cash discounts. And then let's look at the main thing, the methods of pricing materials. And we are saying that there are 4 main methods: the cost price, market price, the average price, and standard price. And cost pricing is a system of using an actual price of goods issued, and it may be applied in 2 ways: first in, first out, or last in, last out. And the most acceptable or accepted practice of these 2 is the first in, first out. So let's look at how cost pricing method works. Okay, let's look at how these ones work. So this is the cost pricing work example where we have the receipt, we have the quantity, cost price, value, and the issue part the same, and we have the balance. Now we are saying that the cost pricing method uses the first in, first out. So we have received at a certain date 100 quantity of, let's say, some products, or let's use this boxes of mineral water, 100 of it at 25, and when we multiply this by this, it gives us for 2,500. And so this quantity of 100 is what we have here. We bring it to the balance, and then 2,500 is the total value. So this value here is moved here, right? Now, this was issued at 25. Now, the next receipt was 100 at 30, and that gives us what? 3,000. 100 plus this 100 gives us what? 200. This 3,000 plus 2,500 gives us 5,500. Now, at a certain date, we also did an issue. So receipts at issue deduct. So we are issuing 40. Remember, first in, first out. So we are going to use this price to issue. So we are issued this as what? 25. That gives us 1,000. But 40 minus 200 gives us 160. Then 100 minus 1,000 minus 5,500 gives us so like I said, we have 40, 25 issued at this 25, and that gives us 1,000. We deduct 40 from 200, it gives us 160. And then 1,000 minus 550 gives us 450. Now the next issue is 60. But remember, this one is still first in, first out. So we are left with 60 here. The first 40 came from this issue. So this 60 is also coming from here at 25. It gives us 1,500. 60 minus 160, 100. 1,005 minus 45 gives us 3,000. And then we go to the next issue. Remember, now this 100 is gone, 40 plus 60. So now we are issuing this 20 from the 30. Okay, so that is the next one, because we are issuing first product, first out. And that gives us 20 times 30 gives us 600. We deduct 20 from 180. We deduct 600, the total from 3,000 gives us 2,400. And then now we have a new issue. Remember, this 20 from 100 at 30 is left with 80. A new receipt of 400 at 35, it gives us 4,500. 400 plus 80 gives us 480. And then 14,000 plus 2,400 gives us 16,400. Now that's the next issue. You remember this 20 from 100, we're left with 80. So we are now issuing 80 at still 30. And this gives us 2,400. 80 minus 4,000, 480 gives us 400. And then 2,400, that is 80 times 30, gives us what? 6,400. And then no, 2,400 minus this 16,400 gives us 14,000. And then we do another issue of what? 40. Remember, these the first 100, second 100 have all been issued. So we are on this. And this one will be issued at 35. The idea is to have the first product in and the first one is issued. Okay. And that is the whole idea of it. Now, so we are saying that these are the advantages of, as it were, the this type of what pricing. That is the cost pricing. It will be seen that anytime the value of a balance on hand is an amount of money which is actually being paid for the amount of stock at the price of the latest consignment. And another advantage of cost price method is that since issues are charged at actually prices, no apparent profit or losses arise as a result of pricing arrangement. Okay, so these are the advantages, and the disadvantage is cumbersome and costly in operation, particularly if there's a lot of movement and purchase pricing. And it does not provide a good basis for comparing job cost, because job costs might be different. That is possible to it's possible for materials to be issued at the same time for two jobs, but different prices. Okay. Now the other one is the average stock. The average pricing. We say the average pricing, not average stock. Average pricing, where there are three kinds of average pricing: the simple average, weighted average, periodic average, and moving average. For the purpose of this study, we are going to consider the weighted average. And we are saying that the price is arrived at by dividing the total value of the stock of the given item by the total quantity. Take note of that. And it is necessary to calculate a new price for each commodity every time a new delivery is received. Anytime a new delivery is received. So take note of that. So we have the receipt, this time quantity cost price per unit value, quantity cost price per unit for the issue part, quantity average and value, because we're dealing with the average pricing. So let's see how it works. It works out. So the first one is this, which is the quantity received, which is the quantity received, and at the price of what, 20. And then when you multiply this by this, it gives you what, 2,000, sorry. So this is what we bring here as what? The quantity. And then we have multiplied this by this already, and this gives us 2,000. So this 2,000 now comes here. Now, how do you determine this? We are saying that it is, the formula is given by what? The total value, which is this, over the total quantity. So 2,000 divided by 100 gives us what? The average price of what? 20. Another consignment at 30. And 100 times 30 gives us 3,000. So the same, we bring this 100 out to this, it gives us what? 200. 3,000 goes to add to what? 2,000, it gives us what? 5,000. So we want to ascertain the average price, which is the total volume, the total value here, over the total quantity. And that gives us what? 25. So you see how it works out. And when we are issuing, we are not doing first in, first out. So the first one is 40 at what? The average price. And that gives us 1,000. We deduct 40 minus 200 gives us 160. And then 1,000 minus 5,000 gives us 4,000. But the price issued was what? 25. Another time, another issue, 80. Still the average price until new stock comes in. It gives us what? 2,080 minus 160. It gives us 80. 2,000 minus 4,000. It gives us 2,000, and it's at the same price. So a new consignment is received at 60. And that gives us what? 12,000 when we multiply this by this. So this one is 200. Goes to add to 80. That gives us 280. 12,000 adds to 2,000. It gives us what? 14,000. Okay. So how do we ascertain calculate this price? It is the total value over the total quantity, and it gives us 50. And it goes on and on. So you realize that with this method, you're actually averaging the pricing, and it has its own advantages. It has its own advantages. So we are saying that it has advantage of minimizing the effect of rapid and substantial price changes and showing the stock remaining at cost price. And also, the principal disadvantage is the amount of calculating work involved, because you have to do the average, and this may be overcome by the use of mechanized system like using Microsoft Excel and other things just to calculate this. So it's not actually an issue. It could be dealt with if we decide to go on that tangent. You can easily deal with that. Okay, so that is not actually a problem. So let's look at the other ones. The market price. The market price. The market price is a sale of pricing all materials issued at the prevailing market price and at the time of issue, and is sometimes referred to as a replacement. So unfortunately, during the time of rising prices, the stock balance may be very much in exceptional cases, it appears to be a negative figure. On the other hand, if prices are falling rapidly, the stock remaining is seriously overvalued, and that sums have to be written off to reduce it to the market value. So this is also good. It's a good deal of work, or a great deal of work that has to be done in obtaining information and keeping the market prices up to date. So this is it, and this one is straightforward. So we are not using the FIFO, we are not using the averaging. All that we are saying is that we are looking at the market price. So we are receiving this amount of 100 at 25, and that is giving us 2,500. And if you look at this, we have quantity, cost price per unit value, quantity, market price, and then value and quantity value. So the 100 goes here, and then we don't bring the price in here because we're using the market price. So this times this gives us 2,500. This is what we have here. Okay. So another receipt at 30, 3,000. So 100 plus 100, 200, and 3,000 plus 2,500, 5,500. Now what's the issue? When we are issuing, the market price is the current price. So this is what we are using. We are not using this one. because the difference between this and the cost pricing is that the cost pricing uses the FIFO method, the first in, first out. This one is dwelling on the market price, the current market price. So whichever stocks comes in is received. When we are issuing, we look at the market price, and it's straightforward. So you see that 80 at also what 30 market price. And then when there's a new stock received, which is 400 at 40, now this one gives us 16,000. Now, when we are issuing new stock, we are looking at 40, not 30, because 40 is the prevailing market price. So that's how this works, okay? That's how this works. And we are saying that standard pricing, standard pricing is a predetermined price fixed on the basis of up-to-date knowledge of the market prices and condition. That's also another pricing method. And it is set for a given period time, example, 6 or 12 months, and it is kept fixed during that period. And this is what some people call hedging. We do that most of the time. We hedge the price at a certain price level, and then within a certain stipulated time, whether the prices go up or not, we still hedge. And in hedging, we factor in inflation and other things just to make sure that we do not have some losses. So that's about the standard price aspect of it. And we are saying that as both receipt and issued are valued as standard price, there's no real need to show the total value of each transaction on the stock record, because the value of the stock on hand at the time is easily calculated by multiplying the quantity balanced by the price. The standard prices are generally used with accounting technique known as standard costing. That's what it's used for. The standard price advantages, clerically, it is easier than other methods by eliminating variation in cost due to price changes. It also gives better indication of efficiency in the use of materials, and it also avoids any delays in obtaining a price, and therefore speeds up record posting and costing operation. So the use of pricing methods. Let's see how these pricing methods are used. It is important to understand that each pricing method has its own particular use. There's no one straight method of using the pricing. And you might have some particular product or inventory that will need the standard pricing, others will need cost pricing and all that. So we are saying that standard prices are very common in mass production factories and production items, and commonly used in armed forces, armed service operations. Cost prices are usually employed in jobbing, shopping, or equipment or machine, and market prices are suitable for many raw materials. And then average prices are convenient for tools, fixtures, and spares. So each pricing method has its own type of inventory that you can use to maintain. So there's no hook, line, and sinker strategy as to which one to apply. It depends on the type of inventory. For instance, if you're dealing with perishables, then you will as well go for cost prices, because that one is because it's perishable. The first product that comes in must leave. And okay, but when you're dealing with mass production, you're dealing with product like steel and coils, which expiry date is not an issue, then you might not want to go into that tangent. So each inventory type, each pricing method is determined by the type of inventory that one is maintaining at any point in time. So have inventory management expert or procurement expert, your managers, you need to look at which pricing method and then the type of inventory that can go with it, so that you can make informed decisions and do not create problems for your organization, but rather become very efficient in using this pricing method in achieving competitive advantage for your organization. Thank you so much. We'll meet in the next section.